The U.S. government debt currently stands at $23 trillion. If we divide this by the total population of America, then we get $70,293. This is the burden of national debt that each American has to bear, and it will keep on increasing because America has an ever-increasing debt. In order to understand the American debt problem, we need to look at the history of debt in America. Complexity doesn't make the national debt an irrelevant issue, and the scope of America's borrowing does matter a great deal. To fully understand that, we have to see how and why America's debt has grown more or less steadily since those first colonists got ticked off about paying their taxes in the late 1700s. A look at this graph tells you how the U.S. federal debt situation has worsened over the years. Since the 1970s, U.S. has gone through at least 7 phases of recession. U.S. debt problem began with the Revolutionary War. Well, some things never change. U.S. financed wars back then with debt, and it does so now in the same manner. The fledgling United States issued loan certificates to governments in Europe to help pay for the war, and by the time official reports began in 1783, it owed $43 million. Yet the system of U.S. debt didn't entirely formalize until 1790 with the Revenue Act, when Alexander Hamilton, America's first Treasury Secretary, began issuing a new series of federal bonds to collect the debt of the colonies, now states, into one guaranteed federal obligation. This established what has become an essential principle of the U.S. federal system: the country, all of the states combined, has one economy with all debts ultimately secured by the national government. America has been in debt from the first shots of the Revolutionary War, and largely for 2 reasons. First, running a large nation is expensive. Second, fighting wars is expensive. But between 1965 and 1978, 2 issues profoundly and permanently changed America's finances. First, in 1966, Lyndon Johnson signed the Medicare program into law, creating one of the most expensive and enduring social programs in the country's history. And then from roughly 1965 to 1975, America fought the Vietnam War, yes, another war that greatly increased the debt. Vietnam and Korea were the first 2 major undeclared wars in U.S. history, and Vietnam was by far the more expensive one. Without a declaration of war to put the country on a wartime economy, Congress paid for Vietnam by increasing the national debt. Over the course of the conflict, America's debt nearly doubled, growing from approximately $317 billion in 1965 to $620 billion in 1976. By the time the Vietnam War ended, the American economy was in a recession, and the Fed cut the policy rates to stabilize the economy. This graph shows the 10-year Treasury constant maturity rate, and it can be clearly seen that whenever the U.S. economy went into a recession, Fed cut the policy rates to stabilize the economy. Once again we come to the significance of this later. Let us first go back to a look at how the U.S. debt rose to the level it is today. The rate of indebtedness then grew even faster under President Ronald Reagan's 1980s administration. The Reagan era introduced America's modern debate over the role of taxes in economic policy. To this day, a significant wing of the Republican Party believes firmly that taxes must only be cut, never raised. This anti-tax approach coincided with a massive military buildup as President Reagan sought to spin the Soviet Union into oblivion. By the time the Berlin Wall fell in 1989, public debt had climbed from $907 billion in 1980 to $2.85 trillion in 1989, approximately $5 trillion in today's money. This was the first time since the Great Depression that the debt-to-GDP ratio climbed during peacetime. Debt would generally continue to climb over the presidencies of George H.W. Bush and Bill Clinton, although the rate of growth slowed considerably after Clinton got Congress to enact tax increases early in his first term. Still, public debt ended the millennium at $5.65 trillion. The growth of public debt slowed from $200 billion to $400 billion per year in the 1980s and mid-1990s to roughly $100 billion per year in 2001, and many observers hoped President George W. Bush would continue that trend. Instead, 2 things happened in short order. First, the administration spearheaded a significant tax cut that dramatically ratcheted up deficits. Second, the September 11, 2001, terror attacks quickly led to an American invasion of Afghanistan followed by an invasion of Iraq. Neither invasion was funded by additional taxes, and the national debt began growing at a rate of $400 billion to $500 billion per year. This rate of growth was pushed to $1 trillion per year by the 2008 financial crisis as the Bush administration launched spending programs to combat the worst of the downturn's effects. President Barack Obama continued this policy. During his first term, Obama oversaw spending that grew the debt at a rate of well more than $1 trillion per year, although that rate fell by more than half later in his presidency. In the last 4 years of Trump presidency, U.S. federal debt has climbed from $17 trillion to almost $23 trillion today, growing at a rate of over $1 trillion per year. Now that we have seen how the debt has come to this dangerously high level, let us look at the reason. So far we have had only a cursory glance. It began with Reagan, who introduced the debate about tax cuts and debt. Reagan said, "We presented a complete program of reduction in tax rates. Again, our purpose was to provide incentive for the individual, incentives for business to encourage production and hiring of the unemployed, and to free up money for investment." Now the subsequent rulers of America reversed the tax cuts by increasing the tax rates, but this shows us one major reason why the debt levels in America keep rising. Whenever a government cuts taxes, let us take for example Trump administration, which gave a tax relief to big corporations and the super rich, in order to entice them to invest more, but we know this is an old script. What really happens is that tax revenue is one of the key sources of raising income for expenditure for any government, and when you give a tax cut, you are basically reducing your tax revenue. When you reduce the tax revenue, you reduce the money available to spend on public expenditure. So when the Trump admin rolled out the tax cuts, it later realized that it needed to raise money to finance public sector spending, and so it went back to the same corporations and super elite, to take a loan from them in the form of government treasury bonds, etc. Can you see the flaw in the system now? The corporations and the super rich, who got a tax cut by the government, ended up giving a loan to the US government, and now the US government not only owes them the loan but also interest on that loan. According to government estimates, the total cost of tax cuts alone is $1.6 trillion. This means the government needs to raise an equivalent amount of debt to finance public sector spending. So tax cuts are one major reason for the rising debt. Secondly, as mentioned before, the USA is a big country and you need a lot of money to run it, and all of it is not going to come from tax revenue. And thirdly, US has been constantly at war in the last few decades, and the wars have been funded through debt. Therefore, as a result of all the wars, overspending, tax cuts to aid the super rich, the US economy now stands at a huge debt of $22 trillion, that will continue to rise. As US-Iran tensions increase, if this blows up into a war, be ready for another exponential increase in debt to finance the next war. The people of US, who are the taxpayers, need to understand this before they go to vote the next time. Your national debt is already dangerously high, and so far no government or candidate has given a workable solution for the debt problem. In the future videos, we will look at how the debt levels are taking the US economy towards another economic meltdown, so do not forget to hit the like and subscribe button. Closing parenthesis.